And joining us with greater perspective on the year that was for Remgro is company CEO Jannie Durand. Jannie, thanks so much for your time this afternoon. So a big difference from the last financial year where earnings declined on the back of corporate activity. 12 months later and a lot has changed. HEPS up by double digits. Put that performance into perspective for us.
Yeah, thank you and good afternoon. We are extremely happy with the results. So good momentum across all our businesses. I think the effort that we put into the last 5 years in this business, bedding them down, bedding the corporate transactions down has bear fruit. So yes, if you take a portfolio, more than 80% of our portfolio have actually got good momentum, contributed positively to the earnings, which actually is a big change from last year where things were still up in the air with some of the corporate transactions, things like that, and things are starting to be bedded down. Some of the regulatory approvals has come through on the CIVH Vodacom deal. So that's all good news, and we're a bit more on the front foot, where last year we were probably a bit more on the back foot.
So you've managed to bed down most of the corporate action and now, upbeat showing from most of your investee companies, and that really filtering through to the bottom line. Talk to me about the quality of the portfolio. Jannie, Remgro has been, of course, going through a phase where it's been streamlining its portfolio.
Yes, I think the quality of the portfolio actually bears fruit in the cash flow that is coming through at the center. As you can see, we've increased our dividends significantly. So the cash earnings at the center has been good. So all our underlying investments have paid good dividends. So, and I always say cash flow is a good indicator of the quality of your underlying investments. And if you look at across the portfolio, Mediclinic, Outsurance, RCL is now starting to pay dividends. So it's all a good story all around, and the cash flow is coming through at the center. And that also is sold some BAT, the last portion of BAT shares that enabled us also to pay a special dividend of R2 a share. So I think the cash flow at the center is good. We're sitting no debt, we're debt-free, sitting on a cash, some good cash at the center, and that enabled us to actually increase the dividends quite nicely.
And you talk about, that cash flow and how pretty you are sitting when it comes to your cash. And if I remember correctly, I think even Outsurance declared a special dividend last week. Just on the performance of your investee companies, Jannie, does this speak to also a improving operating environment? One example I'll make is with Rainbow Chicken, right? Over the past financial year, we did see no load shedding, and we didn't have cases of bird flu as well.
Yes, absolutely. Clearly, load shedding had a big impact on our business in the past, so with that disappearing has had a positive influence. I think if you look at Rainbow specifically, in your feed cost and things have been quite stable and coming down, so that helped. But there's also harder, not just things outside your control, things inside our control. We paid the management team at Rainbow paid a lot of attention to the detail, the farming practices, so forth. I think overall the operating environment is not that easy.
Okay.
There's muted GDP growth, so kudos and compliments to our underlying investment for performing actually very well in a very difficult operating environment. The pie is not getting bigger. The pie, as you know, of GDP growth, real GDP growth being muted, is not getting bigger. So it's really a point of actually in this environment to make the best of yourself, stealing market share and operating more efficiently, especially on the cost side.
And talk to me about the turnaround we are seeing in Heineken over, the past financial year. The group, of course, wasn't profitable. We are seeing those strategic initiatives coming to bear, and we're seeing that playing out in that performance, and of course, that boosting the company as well.
Yeah, I think it's very positive. There's good momentum at Heineken Beverages. I think it also boils down to that the management team is now settled. The integration has been done. Always this merger takes time, integration. There's uncertainty around people and things like that. But the new management team has been bedded down. They're very positive. They're excited about the prospects, and it's coming through in the results. And we're looking forward to an exciting second half of the year for Heineken, especially coming the festive seasons at the end of the year. We're well placed for that. So the supply chain is sorted out, your cost base is sorted out, so it's all positive in that respect. Now we must just sell more beer and wine.
And I'm sure we will. As you mentioned, the festive season is coming up, and a lot of us will be feeling a little more celebratory. Let's look at some of the pressure points, right? You mentioned that more than 80% of the portfolio achieved headline earnings growth. What about the 20%? What were the pressure points there?
The one is actually quite easy to explain, or the two of them are easy to explain. Total Energies, our company there actually, on the underlying basis, they actually did well in operation. They performed quite well. It was just a stock revaluation reserve where the oil price dropped, so they had to revalue their stock, and that influenced the earnings. But on the operating side, we're actually very, very satisfied with the performance. The other company is CIVH, which really consists of Dark Fiber Africa and Vumatel. So then actually the operational performance actually improved quite a bit from last year, but what has affected the results was an interest rate hedge that was actually, because we've got quite a significant amount of debt in there, and we hedged the interest rate, and the market of interest rate dropping, that actually went against us, so there was an impact on the income statement. So although the 20% didn't actually contribute to the positiveness, the underlying performance, we're still very satisfied with that. Yeah.
And on CIVH, we know that the Competition Commission has now given the Vumatel, or rather the massive Vodacom deal, the green light. Just walk me through where to next with that deal.
Yes, there is one outstanding item that it's a CASA approval, so apparently that's imminent. So CASA just needs to get the final approval, and hopefully we'll get that very quickly. And then we want to implement the deal as quickly as possible. And as Dietlof has said in the results presentation this morning, we're ready to actually then roll out more fiber, especially in the underprivileged areas where it's most needed. If we've done this, we could have done this 2 years ago. The deal was approved quicker, and now we're going to do some catch up this, and we're very positive about that.
And you mentioned the cash on hand and the contributions from some of the investee companies. Walk me through the growth opportunities moving forward, especially as, we've also had that CIVH deal with Vodacom being bedded down. What do your capital allocation plans look like?
So we're certainly looking to underlying companies to identify opportunities in their spheres of field where they actually operate, to find new maybe inorganic growth areas as well that we can support. So we're always keen on that. As I said this morning as well, we're open to look at new investments, new areas to invest. So that is definitely on the cards, and we'll continue doing that. Then certainly what we've done as well on the capital allocation side, as you've probably seen, we've increased our dividends, we've increased special dividends. The other things that we probably will be looking at is share repurchases. So it's all of those things are on the card, but it's actually, once you actually got no debt and once your cash flow is very strong to make these decisions, it actually can make them on the front foot a bit, and so we know that we can move forward and make some hopefully value-enhancing decisions on the capital allocation side.
And are there particular sectors, growth areas that you've identified, Jannie, particularly in this, this tough operating environment? You want to be in a growth sector.
Yeah, I think it's difficult in the South African environment. As I said, it's not an easy operating environment. And as we know, very muted GDP growth. Many industries got overcapacity. So the growth opportunity per se is very limited. So you have to bet smart, think outside the box, to look for other things, areas of investment. But in your traditional areas, unfortunately, there's overcapacity. And unfortunately, we've seen some closures of businesses in the last few months. I mean, we talk about Whittier, ArcelorMittal, AMSA, we're talking about Murray and Robert. So I wish I could see more of these opportunities, because the more opportunities you see, the economy is growing, people are actually thinking, they become entrepreneurs, they're working in approaches. But unfortunately, at this stage, because of the operating environment, the opportunities are scarce and few between.
You really can only control what you can control. And with that being said, I see that the company has also managed to keep finance costs low. Just walk me through that.
Yes, what we did is what happened at the end of last year, we still had debt. So we've redeemed the debt. So we're debt-free now, so we don't pay any interest. So that has disappeared off the income statement, the finance cost line. And what you will see going forward, on the cash balance, interest will actually earn finance income. So that has been a significant shift in our balance sheet composition.
All right, Jannie, thanks so much for your time and taking us through the year that was for Remgro. Now, that was Remgro CEO Jannie Durand.